The product improved. The pricing power did not. Consider a publicly traded enterprise software company in Austin reviewing Q2 results with cautious optimism. Generative AI features had been added to the flagship platform, and customers were reporting measurable productivity gains. Under conventional capital allocation assumptions, that differentiation should have supported higher contract values, stronger renewal terms, and more durable gross margins under quarterly pressure. Instead, by the following quarter, win rates softened. Customers referenced comparable AI capabilities from competitors and demanded expanded scope or deeper discounts to close. What had looked like a clean margin expansion opportunity had quietly become something narrower. This is one of the central economic tensions in AI-driven markets. The same technology that appears to create new differentiation can accelerate the forces that erode pricing power. The capability gains are real, but under rapid diffusion, sophisticated procurement, and public market scrutiny, those gains often become buyer leverage before they become sustained seller margin. Picture a simple relationship sketch. Perceived differentiation rises when AI functionality first appears scarce. As competitors match the capability, the line flattens. The value does not disappear. The portion captured through price begins to erode. Early in the cycle, vendors can secure premium pricing while the advantage feels distinctive. The buyer sees productivity gain, and the seller can still frame that gain as proprietary. But marginal cost compression changes incentives quickly. As inference costs fall at scale, vendors face pressure to pursue volume through more competitive terms. What appears as pricing flexibility often registers as accelerated concessions. The compression point is simple. The company gains advanced capability. The customer gains measurable leverage. The market gains rapid comparability. Only one of those three reliably supports durable pricing power. Customer behavior under U.S. enterprise conditions adds the next constraint. Procurement teams operating under quarterly budget discipline recalibrate willingness to pay once they observe functional parity across vendors. The productivity benefit remains, but more of it becomes buyer surplus through discounts, bundled scope, longer commitments, or more favorable renewal terms. The value is created. The capture window narrows. The feature improves the product before it reliably improves the margin. Service businesses encounter an even sharper version. AI improves consistency, cycle time, and output volume. Clients translate those efficiencies into lower fees or expanded deliverables at existing rates. The provider may become more productive, but the commercial conversation shifts before the margin benefit settles. Platform companies face their own variant. Network effects and proprietary data can temporarily protect pricing power, yet standardization of model capabilities still pressures willingness to pay. Usage can expand while average revenue per user grows more modestly. Revenue growth can mask pricing degradation. Sales incentives intensify the effect. In public markets, teams measured on revenue attainment often respond to competitive parity by trading margin for bookings. The deal closes. The quarter is protected, but the new terms become reference points for future negotiations. What registers as short-term success resets category price expectations downward. Model provider dependency compounds the pressure. When vendors rely on similar foundational capabilities, differentiation becomes harder to defend. Data moats remain valuable, but harder to monetize once customers treat strong AI performance as baseline functionality. The premium survives only while meaningful comparison remains difficult. The forces do not arrive separately. Differentiation decays before capital models adjust. Procurement converts product value into buyer surplus. Sales teams protect bookings by surrendering margin. Shared model infrastructure narrows visible difference between vendors. By the time parity is visible, the category has already begun to reprice. Organizations that treat AI primarily as a feature layer rather than a structural economic redesign encounter a recurring sequence: initial pricing optimism, rapid adoption, broader comparison, and gradual margin compression. The technology delivers real efficiency, yet that efficiency moves through the competitive system faster than many investment cases assume. It lowers delivery cost while weakening the barriers that once supported premium pricing. The relationship sketch becomes useful again here. The curve rises when AI feels scarce and distinctive. It flattens when AI becomes expected baseline performance. The important question is not whether the feature creates value. It is whether the firm has enough non-replicable architecture, workflow depth, switching cost, data advantage, or ecosystem control to retain that value through price. Quarterly earnings pressure shortens the time firms are willing to defend premium pricing. Instead of waiting for differentiation to prove itself, teams adjust price to preserve deal velocity. Legacy integration can slow compression because embedded systems remain costly to replace. But as integration layers standardize and APIs become increasingly interchangeable, those moats weaken. The advantage narrows where replication becomes easiest. This explains why AI-enhanced software businesses can report strong feature adoption while still facing margin pressure. Customers use the capability. The vendor may grow faster, but once similar functionality is visible across the market, more surplus shifts away from the provider. Pricing power in AI-driven markets depends less on technological leadership by itself and more on the structural conditions around that leadership. How durable the differentiation is, how quickly customers compare alternatives, how strongly the product is embedded, and how aggressively competitors price for share. The advantage holds where AI remains difficult to compare, difficult to replace, and difficult to price down. It narrows where capability becomes visible, portable, and expected. Understanding where the curve flattens matters as much as understanding where it first rises. A firm may build the feature, deliver the productivity, and still lose the premium if the market can compare the value faster than the company can defend it. In AI-driven markets, pricing power does not disappear because the product stops improving, but because improvement becomes easy to compare, easy to copy, and easy to price down.